The 12th of November 1999. President Bill Clinton signs a piece of legislation with a name so boring that most Americans never heard of it. The Gramm-Leach-Bliley Act. It passed the Senate 90-8, the House 362-57. Bipartisan support. Celebrated as modernization. Banks cheered. Wall Street championed it. And with the stroke of a pen, Clinton dismantled a Depression-era safeguard that had protected the American financial system for 66 years. The law reversed the Glass-Steagall Act of 1933, legislation passed after the catastrophic bank failures of the Great Depression. Glass-Steagall had erected a wall between commercial banking, the business of taking deposits and making loans, and investment banking, the business of underwriting securities and trading. That wall had kept your savings account separate from Wall Street's casino. But in 1999, Congress tore it down. Commercial banks could now merge with investment banks. Your deposits could be used to fund speculative trading. The conservative business of lending to businesses and families could be mixed with the high-risk world of derivatives and mortgage-backed securities. 9 years later, the global financial system collapsed. Lehman Brothers fell, Bear Stearns disappeared. Merrill Lynch was sold in a fire sale. AIG required an $85 billion bailout. The government pumped trillions into banks to prevent total collapse. Millions lost homes, jobs, savings. The disaster that started in 2007 and exploded in 2008 became the worst economic crisis since the Great Depression. And many economists, including Nobel laureate Joseph Stiglitz, would argue that it traces directly back to that 1999 law, the one nobody talked about, the one that secretly engineered the crash. To understand why the Gramm-Leach-Bliley Act mattered, you need to understand what Glass-Steagall did and why it existed. The Glass-Steagall Act, officially the Banking Act of 1933, was emergency. Legislation passed during the depths of the Great Depression. Between 1929 and 1933, approximately 9,000 banks failed. 9,000. When banks failed, depositors lost everything. No FDIC insurance existed yet. Your life savings vanished if your bank went under. Congress investigated what caused the failures. They discovered that many banks had been using depositor money to speculate in the stock market during the 1922 boom. Banks would take grandma's savings account and bet it on stocks. When the market crashed in 1929, those bets went bad. Banks couldn't cover depositor withdrawals. They collapsed. Depositors, who thought their money was safely held in reserve, learned it had been gambled away. Glass-Steagall separated these activities. Commercial banks could take deposits and make loans, but they couldn't underwrite or deal in securities. Investment banks could underwrite securities and facilitate trading, but they couldn't take deposits. The wall protected depositors from having their savings used for speculation. It prevented conflicts of interest where banks might push bad investments on clients to profit from underwriting fees. And it worked. For 66 years, from 1933 to 1999, America didn't experience banking crises on the scale of the Great Depression. But by the 1982nd and 1992, the financial industry was chafing under Glass-Steagall restrictions. Banks wanted to expand into securities. Investment banks wanted deposit-taking power. They argued that the law was outdated, that it prevented American institutions from competing globally with universal banks in Europe and Japan that could do both commercial and investment banking. Lobbyists descended on Washington. Campaign contributions flowed. The pressure built year after year. The dam really broke in 1998 when Citibank and Travelers Group announced a merger creating Citigroup. This was illegal under Glass-Steagall. Citibank was a commercial bank. Travelers owned Salomon Smith Barney, an investment bank. The merger violated the law. But the companies had obtained a temporary exception, a loophole that gave them time to divest conflicting businesses. Except they had no intention of divesting. They were betting Congress would change the law. And they were right. The architect of repeal was Senator Phil Gramm of Texas. Gramm, former economics professor, was a fierce advocate of deregulation. He chaired the Senate Banking Committee. Along with Representatives Jim Leach and Thomas Bliley, Gramm crafted legislation to dismantle Glass-Steagall. The financial industry supported it overwhelmingly. Citigroup alone spent millions lobbying for passage, according to reports from the period. The debate in Congress revealed two camps. Supporters argued that Glass-Steagall was anachronistic, a Depression-era relic preventing innovation and efficiency. They claimed American banks needed the ability to compete with foreign universal banks. They insisted that modern risk management and regulatory oversight made the old separation unnecessary. Senator Gramm declared the legislation would unleash a new era of prosperity, allowing banks to better serve customers through one-stop financial shopping. Opponents warned of exactly what would happen 9 years later. Senator Byron Dorgan, Democrat from North Dakota, gave a prophetic speech on the Senate floor. He predicted that in 10 years, Congress would regret the decision and wonder why they passed legislation setting up financial crises. Senator Paul Wellstone argued that combining commercial and investment banking would lead to conflicts of interest and excessive risk-taking. But these voices were drowned out. The vote wasn't close. Senate passed it 90-8, House passed it 362-57. President Clinton signed it with smiles and handshakes. Clinton later defended the decision, arguing that Glass-Steagall repeal wasn't responsible for the crisis because the institutions that failed, Bear Stearns, Lehman Brothers, Merrill Lynch, were pure investment banks not covered by Glass-Steagall anyway. This defense, while technically accurate, misses the broader point about how the law changed the entire financial system's culture and incentives. What happened after 1999 was predictable to anyone who understood the history. Commercial banks, now free to engage in investment banking, dove into the securitization business. They originated mortgages, packaged them into mortgage-backed securities, and sold them to investors. This created the originate-to-distribute model where banks had no incentive to ensure loan quality because they weren't holding the loans, they were flipping them. The conflicts of interest Glass-Steagall had prevented came roaring back. Banks like Citigroup were simultaneously making subprime loans to borrowers, packaging those loans into securities, selling the securities to clients, and in some cases betting against the securities they'd created. Each stage generated fees. The worse the underlying loans, the more fees flowed because volume exploded. Quality became irrelevant when you're not holding the risk. Bank of America acquired Merrill Lynch. JP Morgan absorbed Bear Stearns. Citigroup became a too-big-to-fail behemoth combining commercial deposits with massive trading operations. These merged entities operated with implicit government guarantees. Depositors believed their money was safe because of FDIC insurance. But now those deposits supported enormous trading books and securities operations that carried systemic risk. The culture changed. Former Federal Reserve Chairman Paul Volcker, who opposed repeal, noted that commercial banking had been relatively staid before Glass-Steagall's demise. Bankers assessed creditworthiness, made loans, managed deposits. But after merger with investment banking, the focus shifted to trading, fee generation, and short-term profits. Compensation structures rewarded risk-taking. Traders made millions on bets that could destroy institutions if they went wrong, and the downside risk fell not on the traders but on taxpayers who'd have to bail out failed banks. Joseph Stiglitz, former World Bank chief economist and Nobel laureate, argued forcefully that Gramm-Leach-Bliley helped create the crisis by allowing the creation of banks that were too big to fail. When Citigroup faced insolvency in 2008, the government had to rescue it because its failure would have triggered a cascade. That rescue became necessary precisely because of the structure that Glass-Steagall repeal enabled. The other side of this debate shouldn't be ignored because it reveals important complexity. Many economists, including former Fed Chairman Ben Bernanke, argue that Glass-Steagall repeal didn't cause the crisis. They point out that pure investment banks like Lehman and Bear Stearns, which failed, weren't commercial banks and thus weren't affected by Glass-Steagall anyway. They note that commercial banks like Washington Mutual that failed did so from bad lending, not securities trading. They argue the real causes were subprime lending, mortgage-backed securities, credit default swaps, and shadow banking, none of which Glass-Steagall regulated. This argument has merit. Glass-Steagall wouldn't have prevented the origination of subprime mortgages, it wouldn't have stopped securitization, it wouldn't have regulated the shadow banking system where much of the crisis originated. Countrywide, one of the worst subprime lenders, wasn't a Glass-Steagall institution. AIG, which nearly brought down the system with credit default swaps, was an insurance company, not a bank at all. But this misses the systemic point. Glass-Steagall repeal changed incentives and culture across the entire financial sector. It created too-big-to-fail institutions that combined deposit-taking with securities operations. It allowed conflicts of interest that drove bad lending. It encouraged the compensation structures that rewarded reckless risk. Most importantly, it sent a signal. Government believed deregulation was safe. That belief permeated the system, encouraging lax standards everywhere. Senator Gramm himself went on to become vice chairman of UBS's investment banking division after leaving the Senate, a textbook example of the revolving door between regulation and industry. UBS would later pay billions in fines for its role in the subprime crisis and various scandals. Graham's trajectory from architect of deregulation to profiting from the deregulated system he created symbolizes much of what went wrong. The aftermath of 2008 saw some attempt to restore protections. The Dodd-Frank Act of 2010 included the Volcker Rule, which prohibited banks from proprietary trading, a modest step back toward Glass-Steagall principles. But Dodd-Frank didn't restore the full separation. Banks can still combine commercial and investment operations. They're just subject to more oversight and capital requirements. Whether these measures are sufficient remains to be seen, especially since the Trump administration and later the Biden administration relaxed some Dodd-Frank provisions. Multiple attempts to fully restore Glass-Steagall have failed in Congress. Some politicians, both progressive Democrats like Elizabeth Warren and populist Republicans, have called for its return. But the banking lobby remains powerful, and the financial industry argues that separating activities now would be disruptive and wouldn't prevent future crises, since so much activity occurs outside traditional banking. The question of whether Gramm-Leach-Bliley caused the crisis ultimately depends on how you define causation. Did it directly force banks to make subprime loans? No. Did investment bank failures that triggered the acute crisis result from Glass-Steagall repeal? Not directly. But did it create the conditions, incentives, and institutional structures that made the crisis possible and worse? The evidence strongly suggests yes. Counterfactual history is impossible to prove. We can't know what would have happened if Glass-Steagall had remained. Maybe the crisis would have occurred anyway through shadow banking and pure investment banks. Maybe it would have been smaller and more contained if commercial banking hadn't been mixed with securities trading. Maybe Citigroup wouldn't have needed a bailout if it had remained a pure commercial bank. These remain debated questions among economists. What's not debatable is that Glass-Steagall repeal represented a triumph of industry lobbying over Depression-era wisdom. It represented faith that modern finance had outgrown old risks, that sophisticated risk management and oversight made protective walls unnecessary. That faith proved catastrophically wrong. The 2008 crisis demonstrated that combining commercial and investment banking creates too big to fail institutions, conflicts of interest, and incentives for excessive risk. All the things Glass-Steagall was designed to prevent. Senator Dorgan's 1,999 warning on the Senate floor came true almost exactly on schedule. He predicted disaster in about 10 years. The crisis hit 9 years later. His colleagues who voted for repeal did indeed wonder, in the wreckage of 2008, how they'd made such a catastrophic mistake. The boring law, with the forgettable name, had unleashed forces that nearly destroyed the global economy. The lesson isn't that regulation prevents all crises. It's that some regulations exist for profound historical reasons, born from previous disasters, encoding wisdom about what happens when certain activities mix. Glass-Steagall separated commercial and investment banking because the 1,920 seconds proved that mixing them ends in catastrophe. For 66 years, that separation worked. In 1999, Congress decided history was wrong. 9 years later, history proved Congress wrong. The 1,999 law didn't secretly engineer the crash through some hidden mechanism. It did so openly, predictably, inevitably. Anyone who understood the history of the Great Depression could see what would happen. Some voices warned. They were ignored. The financial industry wanted deregulation, politicians wanted campaign contributions, and the American people, who never heard of Gramm-Leach-Bliley, paid the price with their homes, their jobs, their savings. That's not a secret. That's just how the system works, when you forget why protections existed in the first place. If this changed how you see the connection between policy and crisis, hit that subscribe button. The most devastating decisions are often the most boring, passed with overwhelming support, championed as progress. Understanding how we engineered 2008 might help prevent whatever's coming next. Or maybe we'll just repeat it. History suggests we probably will.